Hello and welcome to the Expat Tax Thailand Australia Thai Double Taxation Agreement webinar. I'm Carl Turner. I'm the co-founder of Expat Tax Thailand. And the purpose of today's webinar is to help people get a better understanding for the changes to the Thai personal income tax rules for foreign sourced income and how the Aussie Thai double taxation agreement works for various assets and how they're taxed. So at Expat Tax Thailand, we're here to help individuals really understand their tax filing obligations, understand the rules so they can make better informed decisions. So feel free to put your questions in the Q&A box and we'll get through those throughout the webinar. I'm delighted to be joined by our guest expert speaker, Andrew Rigney today. He's a chartered accountant and fellow based in Sydney. He's got over 26 years experience in Australian accounting. So welcome, Andrew. He's the director of RBW Chartered Accountants in Sydney, and his team and him help Australians manage and file their Australian taxes. So Andrew will help us answer all the questions on the Australian tax side, while I'm here to help with the new rules and Thai tax filing obligations for the Thai side. So welcome, Andrew.
Great. Thanks very much, Carl. Good to join you from Australia this afternoon, and hopefully I can provide some assistance.
Great. Yeah, perfect. So as I mentioned, please put the questions in the Q&A box. If you are watching the recording, please visit our website and go to the Ask a Question section. If you do have any questions, we'll aim to get back to you. We also have a frequently asked questions section where many of the questions are already answered on there. So quick disclaimer before we start: the content provided is intended for information purposes only. It does not constitute professional tax advice and should not be acted upon just from the webinar. So we'll go through in the webinar today, there's 11 main areas that we'll go through. So we'll discuss the purpose of what a double taxation agreement is for. We'll give it examples. We'll explain the local Thai income tax rules and explain some of the common misconceptions that individuals have regarding double taxation agreements or DTAs. Then we'll give some case studies and practical examples and close with the Q&A and tips. So let's start with, what's the purpose of a double taxation agreement? It's really to set clear rules on how assets are taxed and divide the right for taxation between contracting countries. It doesn't mean if there's a DTA in place, there's no further tax needed. It just sets out the taxing rights for certain assets in different jurisdictions. So anything mentioned in the DTA, it takes precedent over local domestic tax rules. So even if the local rules say a type of asset is taxable, if the DTA says something different, then the DTA takes priority. So the Australia-Thai double taxation agreement, it was signed in 1989, 29 articles. It sets how assets are taxed. So it covers things like pensions, capital gains, and property. Now, at Expat Tax Thailand, we've done the hard work for you. On our website, we've researched all of the 61 DTAs, and they're available to download, including the Australian Thai DTA that's on our website. We'll send out the link to this in the recording as well. So before we get started on the actual Australia-Thai double taxation agreement, and before we go into more detail, I wanted to really take a step back to really explain what are the tax changes that have been announced, and it will really give us a better understanding and grounding for when we go through the case studies. So in September last year, on the 15th, the Thai Revenue, there's a departmental order issued, which overruled the previous rulings. It was published in the Royal Gazette, and it came into force on the 1st of January 2024. Now, this has made a big impact for Thai tax residents who remit. So basically what remit means is transfer in overseas income like pensions, investments, rental income, salary, things like this. The good news was further clarity given by the Revenue Department in November. And what it actually stated was, moving forward, any offshore foreign source income earned after the 1st of January 2024 if it's remitted to Thailand by a Thai tax resident, so that means staying in Thailand 180 days or more in a calendar year, these remittances are deemed assessable income and potentially taxable in the year it's remitted. So who does this affect? Well, it affects anyone who remains in Thailand 180 days or more in a calendar year. So that's the 1st of January to 31st of December. What kind of visa holders this is affect? So if you've got a retirement visa, permanent residence, elite visa, business visa, education, marriage, smart, tourist, all of these are affected by these rules. There's one exclusion, which is the new long-term residency LTR visa. There are quite stringent requirements for retirees. If you would like more information on this, we have a webinar specifically for this and a recording for the actual visa. So now we know who is taxable. Let's talk through the types of assets that are taxable in Thailand very quickly. So here's an extract from the section 40 of the Revenue Code. It just shows all of the 8 categories of assets that are taxable in Thailand. So it shows pensions are in section 2, investments and property sale is section 4, and rental property income section 5, and any other activity not specified earlier is section 8, which covers everything else. So what isn't taxable? Let's go through what assets aren't taxable. So there is a long list of this, which is useful for people because it's not everything that you send or remit into Thailand that's taxable. There are certain assets that are not taxable, that are not classed as assessable income. So any asset or income that's transferred or spent in Thailand that's not transferred or spent in Thailand. So if the money is left overseas, then it's not taxable asset. So it's only a remittance tax basis. It's not a global taxation on worldwide assets. So what we're focusing on is remittance. So anything sent to Thailand. So that's one thing that isn't taxable. If the assets are left overseas and they're never remitted to Thailand, that's not a taxable asset. It doesn't need to be recorded on a tax return. Next, remittance of income from previous tax years when not a Thai tax resident. So if you have cash in the bank from previous years or assets in the bank from previous years, when you were a non-Thai tax resident, that can be remitted to Thailand when you are a Thai tax resident because it's not an assessable income. This also goes on to the next level, which was at the next point, which was mentioned in November by the Revenue Department. This shows any cash in the bank as of the 31st of December 2023 can be remitted to Thailand anytime in the future. This is not classed as assessable income. So this is looking forward from the 1st of January 2024 onwards. So that's important to note. So remittance of original capital. So let's say you do have investments or you have property and you haven't made a gain. Let's say you invested in a property and it's worth less than what you paid for it. You can sell that, remit it to Thailand. There's no capital gain. It's original capital. There's no tax on that. Also, inheritance is not a taxable asset in Thailand for overseas inheritance. If you're a permanent resident, then in Thailand, then it's different rules. But in general, that's the rule. Gifts, so potentially they are taxable under gift tax rules, but not under personal income tax rules. And loans are not taxable in Thailand under personal income tax rules. So if you do have any questions, again, put them in the Q&A box. If you're watching the recording, please go to the Ask a Question section on the website. So let's go on to the double taxation agreement. So we get many questions about the DTA, and it might be good just to explain some of the common misconceptions. So Andrew, it might be good, to pass across to you. What are the common misconceptions that you see, in your over quarter of a century working in accounting with clients? What do you sort of see with this?
That does sound like a long time when you put it like that. Some of the common misconceptions I see with double tax agreements is, if I pay tax in one country, then I simply can ignore it in another country, because I've already paid tax on that income. So, it doesn't become a Thai tax issue if I've already paid tax in Australia. That's a very common misconception. Also, the need to file tax returns in different jurisdictions. Again, if I pay tax on that income in Australia, or rather, if I'm paying tax in Thailand, do I need to even bother filing a tax return in Australia? Whereas the DTA, it doesn't actually exclude you from filing in multiple jurisdictions. Also, another final misconception that I see come up quite a lot is with respect to if an income is tax-free in one jurisdiction, therefore it's tax-free in another jurisdiction. And we'll see that today when we talk about pensions, especially.
Right. Okay. Yeah. Clear. I mean, this tends to be the common misconceptions that we see tend to be around, this has already been taxed. Why should I have to, it's nothing to do with Thailand, and the DTA shows that it shouldn't be taxed. But yeah, as you mentioned, that's not what the purpose of the DTA is for. So it might be good just maybe to just explain, Andrew, what is a tax credit? How does it sort of work in practice? And what can they use this for? If they're a Thai tax resident and they've paid tax in Australia on certain types of asset, what is a tax credit and how do they work in principle?
Yeah, great. So a tax credit arises where tax is withheld in one jurisdiction. So, for example, if you have a bank account in Australia that is earning interest and you're a Thai tax resident, then the Australian bank will withhold tax at the rate of 10% on that income that you're earning in Australia, on that interest income. That's a final tax in Australia for that non-resident. However, in Thailand, I understand that they're required to still declare that income in Thailand, but then they'll get a tax credit for the 10% tax that's already been paid in Australia under the double tax agreement.
Okay. Yeah, clear.
Yeah.
Okay, great. Wonderful. Thanks for that. So let's just go through the general principles of DTA. So you need to really check the DTA for each jurisdiction that you've got assets. Even if it's not in Australia, you've got to really look at the specifics. If you've got assets in USA or any other jurisdiction, you can't just rely on that one Australian double taxation agreement. It matters. If you've got accounts in Singapore, for example, you have to look at the Singapore-Thai double taxation agreement. So you need to look for exclusions and exemptions or any special rules. And if it doesn't necessarily mean there's no tax to pay, we've got it. And then we actually use the Thai personal allowances, not the overseas allowances. This is a common question that we get. So let's go on to the specific Australian assets and how they're treated for tax. What does the double taxation agreement say? So we'll focus on 4 main areas. If people do have other assets they'd like to look at, we can look at it on a case-by-case basis. But on here, we'll focus on property rental income, pensions, so super, government age pensions. We'll look at Australian-based investments, so general investment accounts, brokerage accounts, and then property sale and remitting to Thailand. They're the key assets that we'll focus on today. So let's start with property rental income. So what does the actual double taxation agreement say? It's in Article 6 of the Australian Thai double taxation agreement. It says income from real property may be taxed in the contracting state which the real property is situated. So because it uses the word may, what it means is there's no exclusion on there. So that basically means that if you're a non-Australian resident, you can be taxed on the rental income in Australia. Then if you do remit the money into Thailand, we look at the Thai domestic tax rules. So this falls under Section 40, number 5, which covers rental income. So the rental income is assessable income in Thailand. So there's no specific exclusion on rental property income. So you may be taxed in the contracting state and in Thailand. So how does that work in principle? You would use the tax paid in Australia as a credit. So any tax that you've paid, you can use as a credit against the tax that's owed in Thailand. So I'll go through an example. It might be good for Andrew just to explain, if you are a non-Australian resident, that the tax rate is pretty impressive for property rental income in a lot of cases anyway. So let's just go through this example. So a 64-year-old single remits, so transfers in 2 million baht of Australian property rental income when they're a Thai tax resident in the year that they earn the money. So what are the steps they need to take? First of all, because they have assessable income over 220,000, well, 120,000 because they're single, then they have to file a tax return. So regardless if they have tax to pay, if they're bringing in assessable income as a married couple, is 220,000. As an individual single person, it's 120,000 Thai baht of assessable income. They have to file a tax return. You know, we have a tax filing service for this, assisted tax filing, for example. We calculate their allowances and deductions. So a single 64-year-old would only have their 60,000 personal allowance and then 30% for expenses on the property. They'd need to get a Thai tax ID number if they don't have one already. So they'd need to get one at the local revenue office, or for example, Expat Tax Thailand, we have a paid service to obtain this on your behalf. Then they need to file a tax return showing the tax credits for the tax paid in Australia, and use a filing service like ourselves to actually claim back the tax credit that you'd have from Australia. So it might be a good point, Andrew, just to mention the tax rates for this if you're a non-Australian tax resident with Australia rental property. You know, it's pretty impressive, isn't it? Anyway, so for the majority of people that do this, then, you know, the tax rate is going to potentially be higher in Australia than it would be in Thailand. So it might negate away any taxes, but they still have to file tax return and use the credits.
Yeah, that's right. I mean, the tax rates in Australia for non-residents, they, you know, pretty much start at 30% on the first dollar of income that's earned. So, so yeah, the Australian tax government they do like to tax people on income at quite a high rate.
Yeah. So basically, what it means if you are remitting in property rental income, it's potentially more of an administration issue rather than a taxation issue. But if you don't file a tax return, you don't use the tax credits, it's up to you as an individual to prove that, you know, this is already, tax has been paid. It's not good enough just to say, you know, that there's no tax to pay. You still need to file a tax return for those assets. So let's get on to pensions. So if you look, this is in section Article 18 of the double taxation agreement. So you can see on here, it says pensions and annuity paid to a resident of one of the contracting states shall be taxable only in that state. So what does that mean? It means double taxation agreement. It states that pensions paid to a resident of one of the contracting states shall be taxable only in that state. So pensions in the DTA, it mentions government services like civil service pensions are only taxable in the state that disperses them. So that means that they are not taxable in Thailand, but there is no exemption on there for superannuation, age pensions, things like this, annuities. So how are pensions taxed in Thailand if they're remitted? What's the local domestic tax rules? So this is under section 40. Part 2, pensions. So you can actually exclude up to 100,000 Thai baht as a deduction, expense deduction. But apart from that, then whatever you remit from a pension is assessable income. So under the Australia-Thai DTA, there's no exclusion for age, pension, or superannuation. They are assessable income if they're remitted to Thailand, and taxed if remitted to Thailand, they're classed as assessable income. So we use your Thai allowances and deductions. And yeah, to mention again, the civil service government pensions are tax exempt in Thailand under the double taxation agreement. So let's go through another case study just to explain how this works in principle. Because, you know, if you're over in a certain age and depending on the amount you're remitting in, it may not be a huge burden as people sort of are worrying and panicking about. So let's go for a case study and we can actually see the figures for this example. So for a 70-year-old that's retired in Thailand with a spouse that's not working and an adopted 10-year-old child, if they're remitting in 4,000 Aussie dollar per month transferred into Thailand from their superannuation, then the assessable income per year is about 1.1 million Thai baht. Now let's go through the steps, what they need to take. First of all, we know that they need to file a tax return because it's over that 220,000 Thai baht of income where they have to file a tax return. That would be, really for our service, it would be essential tax filing to file that type of tax return. First of all, we calculate the allowances and deductions. So they get their spouse allowance, which is 60,000, age allowance, which is 190,000, personal allowance, 60,000, plus the child allowance of 30,000. So that we add that all together. They'd have to get a tax ID number if they don't have one already. So again, local revenue office, or we have a paid service to obtain that for clients on their behalf. And then they need to file a tax return. So we'd look at using their allowances, make sure they use all the deductions, and the tax owed on 1.1 million for that example is around 61,000 Thai baht, or 5.26%. So this is on our tax calculator that shows the potential tax for that example. So if you would like a free tax calculation estimate for the tax that you could potentially have to pay, taking into account your personal allowance and deductions, we've developed a free tax calculator service so that you can estimate how much tax you could potentially pay and what the new tax changes might affect you. It is quite confusing, so we're happy to help. So if you'd like to book in a free 15-minute call with my colleague Jason, feel free. We'll send out the link for his calendar to arrange a time to have a chat on Google Meet so that you can actually go through your own situation and really reassure people that a lot of the times it's not as bad as the people think in terms of the tax rates if they do have good allowances and deductions. So next, let's go on to investment capital gains and how that's taxed. So non-property investment capital gains, it's not explicitly mentioned in the double taxation agreement, which means there are no exclusions. So if they're remitted, then it's taxable on the capital gains. So you can see it's in the revenue code, section 40. There are no expenses deductions that you can take for that. So let's just talk through an example. So general investment account or brokerage account, if you partially surrender and transfer to Thailand, if you remit more than 220,000 Thai baht as a joint filer of capital gains in 1 year, then we know you need to file a tax return. You calculate the capital gain in Australia on the assets, and that's the figure that we'd use for the assessable income. File a tax return on the gains, and we can use any tax paid, if there is any tax paid, as a credit. Potentially, there's more tax to pay in Thailand, depends on the amount remitted and the Australian tax rate. So quick example, 50-year-old who's married, no income, 2 kids, local health insurance, bringing in 2 million baht from their investment portfolio, which has 50% capital gains. So the assessable income on that would be 1 million, so 50% of what's brought in. They'd need to file a tax return like the other examples that we've got because of the amount that they're bringing in. That would be our assisted tax filing service because we'd need to use the tax credits potentially on there. We'd calculate the allowances. So with the spouse, children, and local health insurance, they'd need to get a tax ID number if they don't have one already. We'd then file a tax return showing any tax credits for tax paid in the other jurisdiction. And then they'd have to use the filing service to claim back that tax credit. So that's our personal income tax calculator, just showing the calculations. For that example, it would be 6.28% tax on that amount. So let's just recap on the specific Australian assets and how they're treated for tax. So let's talk through pensions first, government, civil service pensions, and super annuities and age pension. So government and civil service pensions, they're not taxable under the DTA due to the exclusion. All other pensions, there's no exclusion on there. If they're remitted, then they're assessable income in Thailand. Let's go through capital gains. So Australian-based investments, you tax on the capital gains. You can use the Australian tax paid as a credit. And property. So rental income is taxable if remitted. It's assessable income if remitted. You can use tax paid in Australia as a credit. And property sale and remit to Thailand, taxable on the capital gains if transferred to Thailand as a Thai tax resident. You can use any tax paid as a credit. So just some quick tips before we go on to the Q&A. So it's important to keep very good records for the remittances. In an ideal world, you keep each asset source separately. So cash in the bank from previous years, you keep separate to new money that's been paid in from super or property rental income. That means when you remit the funds into Thailand, you can clearly show with a track record where the funds are from. If you're selling a property in Australia as a Thai tax resident, I recommend you seek advice. If you haven't moved and become a Thai tax resident yet, I think that's a good point to seek advice as well, to see if there's any planning that you can do before becoming a Thai tax resident. And we are here to help. And if you do have any questions about specific cases, feel free to get in touch and we'll help to explain the rules and give you some practical tips. So let's go on to the Q&A session. We've had quite a lot of questions in. Let's go through this. So if income in Australia is derived from multiple sources, rent, dividends, how is the remittance considered? Can it be claimed the income is only rental income rather than dividend? Yeah, so this is from the tip section. You know, it's up to an individual to be able to prove beyond reasonable doubt that the assets that they're remitting are from whatever source. So it's important that, you know, from now on that you keep your bank accounts clean in terms of the different assets if possible, so that it's easy for you to not have you know, polluted accounts with different types of assets in there. Just for filing purposes, it makes it a lot simpler. Yes. If you are a Thai tax resident and non-tax, okay, if you're a Thai tax resident and a non-tax resident in Australia, if the tax credit exceeds the Thai tax in Thailand, can the excess amount be deducted off other local Thai income tax? Good question. Angie, you might be able to answer this. No, you can't use the tax credit to deduct off other assets. You basically pay the higher of the two. If you paid more tax in Australia, that just means you don't have any more tax to pay in Thailand. That's right, isn't it, Andrew? Sadly.
Yeah, unfortunately.
Yeah. Let's have a look at this. So my question is about Australians moving to Thailand. In the first year of being a Thai tax resident, do you need to be there for more than 180 days to qualify as a Thai tax resident in the year that you arrive? Or does your intention that you continue to be a resident, is it enough to qualify? Imagine the ATO might be quite particular about this, and you may want to be sure what you're doing, doing everything properly. We moved to Thailand on the 2nd of July this year. So good question about tax residency. So I can explain the Thai side. It's very simple. Andrew can explain especially the Australia side. So for it to be a Thai tax resident, then you have to be in Thailand 180 days or more in a calendar year. So if you move in, say, September of one year, then for September, October, November, December, you are a non-Thai tax resident for Thai tax purposes. Just because you moved and the intention is to remain doesn't mean you automatically fall under the Thai tax rules. This doesn't mean for income that if you've had income from work conducted in Thailand, but I'm just talking about for foreign source income as a Thai tax resident. So, Andrew, this is quite complicated for people that are moving. It's important that they seek advice before the act, I think.
Definitely. I'd always suggest seeking advice both in Australia and Thailand before moving over there with an intention to stay there. Um, the good thing in Australia is we do have a concept of pro rata tax residency. In the case of this question, moving to Thailand on the 2nd of July, given that Australia's got a tax year from the 1st of July to 30 June, then obviously for the vast majority of that year, then the individual would be a non-resident of Australia.
Okay, thanks for that. Thanks for that. But one question about pensions, saying, you know, a super pension has already been taxed. It doesn't seem right that under the double taxation agreement, that doesn't help that it's not taxed in Thailand, that it's taxed in Thailand. Andrew, it might be good just to explain a little bit about this, if that's okay, you know, about
Sure.
taxation agreements and the fact that something's not taxable in one jurisdiction necessarily mean another.
Yeah, that's right. At the end of the day, the double tax agreement, it allows countries to tax different types of income. Australia has decided not to tax pension income from superannuation accounts. However, if you're a Thai resident, then I understand it is taxable in Thailand, even though it's not taxable in Australia. So from a Thai tax perspective, that would mean that you would need to declare that in your Thai tax filing. And there would be no tax credit because there's no credit and there's no tax that's been either paid or withheld in Australia.
Right.
So fully taxable on the remittance.
Everything that's remitted. Yeah. Okay. I've got one question here about being a Thai tax resident. I think is misunderstanding of the terms. I'll explain it a bit clearer. So 180 days or more, that's in a calendar year. So you could be in Thailand for 2 months, leave for a while, and then come back. It's the total number of days in the year. It's not consecutive days. So the question was about if I leave for 2 weeks and then come back, I'm not a Thai tax resident yet. It's 180 days or more in a calendar year. It doesn't have to be consecutive. Yes. So I receive a fortnightly military disability allowance, incapacity benefit from Department of Veteran Affairs. Can you verify this is classified as assessable income or whether it's excluded under government service? So yeah, with this pension, it's, you know, our interpretation, this is classed as a government pension, and it doesn't fall under the same rules as normal pensions. It's excluded in the DTA. Yeah, okay. Can you elaborate on what is a loan? Is lending money to a friend on a loan taxable? So yeah, with the loans, in terms of personal income tax rules, the loans are not that are received and not, it's not a personal income tax. It doesn't need to put up on a personal income tax return, but you've got to make sure that the loan qualifies as a loan. So it's got to be a bona fide loan in terms of having an end date and an interest rate being paid. It has to be paid back on a regular basis. Yeah, if you do want any specific advice, what qualifies as a loan and what doesn't, yeah, I'd seek advice, because you don't want to get in a situation where you act with a personal loan and it doesn't qualify, and then the revenue sees through that, looks through that, and everything that's in there is classed as remittance. So you've got to be really careful. You know, it's better, in my opinion, if you are going to get a loan, that it's done through a bank, or, you know, rather than a personal loan, so that it is actually, you know, it can't be seen as a tax evasion, which that could potentially be seen as, because it doesn't need to be included. So if you were audited and you were asked to prove that, then it'd be very difficult. If it was a personal loan, there's no documentation, any evidence on there. Yeah, let's go through a few more questions. Would Thai baht sent direct to Wise be tracked like Thai baht into Thai baht bank would be? I think this is a question on moving money from Australia to Wise. There's no Thailand's a remittance tax basis. it's only when money is transferred into Thailand or spent in Thailand on credit cards or debit cards, that's classed as remittance. If you send money into a Thai baht wallet in a Wise account, that's not actually being sent to Thailand. If you remit that money then into Thailand, that's the point when that's classed as remittance. I hope that clears up the question. Okay, another question. Follow up on your question about establishing Thai tax residency. If you did enter Thailand in September and were doing a notional sale of assets on exit from Australia, would you be a tax resident of nowhere from September until the end of the year?
That's an interesting question. Generally, from an Australian tax perspective, if you're leaving Australia to commence Thai tax residency, you know, you will always fall under as a resident of one of the states, as in one of the countries under the double tax agreement. So if you've ceased your Australian residency but moved to Thailand, then I think under the rules, you would look at where your habitual place of abode would be, or where your permanent abode is, your permanent residence, and therefore you would commence Thai tax residency when you move.
Yeah, so I think this is a prime example of, if this is the case, seek advice, because it's very important that you get it right, because it could have serious implications for taxation if you move in certain types of assets. It's important that you seek advice before doing this. Let's have a look. Income paid / sent to other family members. So I assume this means transferring from overseas into Thailand to someone else other than the Thai tax resident. So whoever you send funds to, whoever you remit funds to, whether you send it to a school or to another third party or a family member, is still classed as remittance from the person that's sending the funds. You know, potentially if they gift the assets to a family member and they never benefit from that, that could fall under gift tax rules. But again, it's not a way to avoid personal income tax. It's a separate rule for gift tax, and you need to have that clearly documented as well. So income paid / sent to a family members, yeah, it still classes remittance if it's sent into Thailand, regardless of who it's sent to. A question on credit cards. So if I use my credit card, Australian credit card in Thailand, is that classed as remittance? So with all questions regarding things like this, you've got to always think, is what you're doing within the spirit of the tax rule? So even if there's nothing in the personal income tax rules or law about using credit cards in Thailand, if you are using foreign source income in Thailand on a foreign credit card, you know, this is likely to be classed as remittance. And even if there isn't a rule on specifics like this, you've got to look at, is it within the spirit of the tax rules? And to be honest, it's not. So, you know, it's likely, well, it should really be recorded on a tax return and taxed on there. Okay, thanks for that. So, you know, we're here to help. We've got a very useful guide to how to file your own tax returns with easy steps to follow. You can download that on the website. And if you would like a free tax calculation service, feel free to get in touch. We can go through your own personal allowances and give you an estimate for how much tax you could potentially have in Thailand and actually look for your own situation. My colleague Jason is ready for the one-on-one 15-minute Google Meet sessions, so feel free to use that. We also, if you'd like to sign up to our mailing list, if you haven't already, we do produce regular podcasts on a weekly basis on taxation, and we have quite a lot of webinars on specific subject. So we'll keep you updated with anything that moving forwards. If you do have any Australian tax filing requirements, Andrew and his team are available to speak to. What are the key areas that really, Andrew, that you could potentially help with Australians living, or Australian connected people living in Thailand? What are the key sort of services that you could help with, Andrew, or potentially help with?
Yeah, we can provide Australian tax filing services for non-residents, and the peace of mind that gives non-residents, just knowing that their Australian taxes are all taken care of. My foreign clients find that quite good. We also offer foreign office services for high wealth individuals who live overseas, whereby we manage their Australian not only taxes but also accounting and business needs as well in Australia.
Okay, great. All right, perfect. That's good. So yeah, if you would like any more information on the Thai personal income tax side as well, feel free to get in touch. So we are here to help, so people can actually understand how this change will affect them. So thanks for listening. Thanks to our guest, Andrew, for joining.
Very good. Thank you, Carl.
Yeah, thanks for your input. It's been very useful. And feel free to reach out with any questions that you have. We're here to help. Any questions for Andrew, I'll forward on to him as well. Okay, thank you. Have a great day.